Hi, everyone. I'm Loic Lemenner, founder of Opus Wealth Management. In this video, I'm going to go over how interest rates affect bond prices and returns. Why subject you to this topic and why do it now? Well, although I intend this explanation to be evergreen, the reason I'm filming it now in April of 2022 is because the first quarter of this year saw a massive increase in interest rates in the US and large associated losses in the bond market. So let's dive in to see how this all works. I like to think of duration like the arms of a seesaw on a playground. The length of the arm determines how much the seats of the seesaw go up and down, right? So if we move to a seesaw with a shorter arm, the ups and downs will be more muted. It's the same thing in the bond market. You bought a 30-year bond, interest rates move up, that bond's price has to drop a lot to make up for 30 years of lower interest embedded in that bond. If you buy a bond that matures in 1 year and rates move up, the bond only drops enough to make up for 1 year's worth of interest rates. So let's go through an example. Here I have, let's call it a bond mutual fund because that's a little easier to think about. I buy it at $1,000. It's got a 4-year duration, which is this triangle fulcrum here, which will be important later. And I'm earning a 3% yield. So I buy my mutual fund, I put down $1,000 and I compound at 3% so that by year 4, I've earned $125. So the total value of my fund is $1,125. Easy enough. Okay, now let's explore what happens if rates increase on us. So the scenario I'm going to paint is rates go up 1% from 3 to 4%. Now, by definition, duration is an estimate of the loss given a 1% move in rates. So my fund had a 4-year duration. So if rates go up, I would expect my fund to lose 4%. And those estimates are pretty exact. And so what I'm representing here is I have a $1,000 bond fund. Rates go up by 1%, I lose 4%. So my bond fund is now worth $960. Now, the interesting part here is I have two forces working for me. I've got my 3% of interest that's embedded in my bond portfolio, but I also have this discount which is slowly but surely going to go away as my bonds get closer and closer to maturity, knowing that as long as they don't default, they're going to mature at $1,000, right? So this discount is getting smaller and smaller. And by definition, once you get to the duration year, you're going to be right back where you started. So rounding error aside, once you get to the 4th year, you've got, in my example, almost exactly the same amount of dollars that you would have had interest rates not moved at all. See how that works? Now, there's a big cherry on top to all this, which is now you're through your duration year, year 4, and you're still living in a 4% world. So you're actually making more money beyond your duration year because in year 5, you're earning 4%, year 6, you're earning 4%, and so on. So you're actually making more money past the point of duration. So, like going to the gym or eating your spinach, bond losses due to interest rates rising are painful short term, but they're actually better for you long term. The key is having your duration at an appropriate length for the amount of interest rate risk that you want to take. Let's look at this exact same effect in a different way. So, this is a 5-year duration bond, and it's showing you 3 paths. So, the blue line is if rates don't move, right? So, rates stay, and this blue line just represents, earning 4% on your money. Now, if rates decrease, fall to 2%, you get in where they originally are at 4%, instantaneous pop, where your bond price goes up by 10%, but now you're living in a 2% world. So you're making less money along the way. And around your duration year, year 5, you're right back where you would have been had rates not changed. But then every year thereafter, you're living in a 2% world. So you're actually making less money, right? So it's good short term. It appreciates your bonds short term for interest rates to fall. But long term, it's bad for you. The reverse, if rates increase to 6%, then you would lose 10% on your bond portfolio. But now you're living in a 6% world. You make up all your losses by your year 5, your duration year, and then the rest is gravy, right? Which is why Having a rise in interest rates is good for bond investors long term, especially the shorter your duration is, right? So, as interest rates fall, what a lot of people do is they shorten their duration so that when an inevitable rise happens, you can take advantage of the rise on in a quicker fashion. So the important part of duration is now we have a tool to control how big of a bet we're placing on current interest rates. If rates are low and you're worried about locking in those rates for a long time, you can shorten up your duration. And if rates are higher and satisfactory to you, you can extend your duration of your bond portfolio and essentially lock in those rates. It gives you very good control over something that is unforecastable, like interest rates. Let's talk about history for one slide. So, this chart shows the interest rate on the 10-year Treasury bond. What's interesting about this is if you look at recessions, which are designated by the gray vertical columns, interest rates dropped 7 of the last 8 recessions. Now, that's good from the perspective that stocks typically drop in recessions. So, if you're getting a short term price bump to your bonds, you can use some of that value to rebalance into stocks. Of course, that didn't happen in the stagflation of the mid 70s, and some people are worried that we're in a stagflationary environment again today. There is one, what I will call duration buster. I hope you like my animation. I'm sure the people at Pixar are very impressed. What is that duration buster? It's hyperinflation. Let's say instead of a percentage move or 2 or 3, we were talking about 1,000% inflation or 1,000,000%. Well, your bond's price can't fall enough to compensate for that kind of inflation and subsequent interest rate rise. So your bond portfolio, in extreme enough cases, could become worthless or close to it. So, what are the takeaways from this presentation? Well, one is know where you are. You should know how long your duration of your bond portfolio is so that you know how long you're locking in the current interest rates and have a good idea of how much interest rate risk you're taking. Number two is like many things in the investment world, somewhat counterintuitive. If rates go up and bonds just lost you money, you may actually want to lean into that loss and extend your duration, especially if now with the new rates, you're getting enough return to meet your financial planning goals. And lastly, if you're worried about hyperinflation, have some diversifiers to guard against it. That could be investing internationally, it could be owning some commodities. There's a lot of different things you could look at to protect against one country's hyperinflation. That's all we have for this video. Congratulations on sitting through a presentation about one of the most boring but important asset classes in the world. Thank you so much for watching. If you want to make sure to not miss any of our future videos, please hit the subscribe button. And if you want to help the channel out, please smash that like button, as the YouTubers say. I appreciate it, and until next time.